Hello and welcome to a special edition of The Insight by Oaktree Capital. I'm your host, Anna Szymanski, and today we're taking you behind the scenes to give you a peek at our latest episode, which was recorded at Oaktree's London offices. This episode is all about European credit. For this discussion, I'll be joined by Armen Panossian, Oaktree's Head of Performing Credit, Madelaine Jones, Portfolio Manager of Oaktree's European High Yield Bond and Senior Loan Strategies, and Nael Khatoun, Head of European Private Debt. For the full discussion, please subscribe to The Insight by Oaktree Capital wherever you get your podcasts. Maybe now let's fast forward to today's markets.
I would say at the tail end of last year, there was the ultimate degree of pessimism about all things in Europe, that the war was going to spiral out of control, that the energy crisis was going to become quite acute in Europe, and access to energy and heat was going to be a problem. And so spreads in the European market were worse than the US, or wider than the US.
Right.
And I think it really incorporated all the worst case scenario for all things Europe at that time. But I think coming out of it, and the winter wasn't quite as cold as people expected, and the energy situation wasn't quite as bad. The ability of the Ukraine military to defend itself was proven time and again. And I think that there's this growing perception that we don't need to assume the worst case in all things in Europe. And so we did see a spread tightening event in European high yield bonds and senior loans that was on top of or even outpaced the US market at times for most of this year so far, because it was wider and more pessimistic. And now it's sort of, I would say, on par.
Now, I know a lot of the trends that we've seen in both European and US markets have obviously been driven by macro forces in the last few years. But obviously at Oaktree, we're bottom-up fundamental investors. And I'm curious what the fundamental work that you've been doing, the conversations you've been having with companies, how that's informed your insights about some of these macro themes. And also maybe, have there been any instances where what you've seen on the ground has differed from what you've seen in maybe broad indicators?
For the most part, I would say in traditional concerns about recessions, you start to worry about the consumer and unemployment and the slowdown of spending. And this environment hasn't really shown that to date. The consumer has been really robust. And there's been a lot of, that I would say is the difference with what you read in the press sometimes about concerns on the consumer. You just haven't seen it yet. But, we all fear that will come. And maybe we're starting to see a little bit of it around the edges of consumer pulling back, even around leisure now, a little bit pullback, a little bit of down trading in food. So maybe you're starting to see it. But what I think is more dramatic is the intermediary companies who are destocking ahead of that. So they're getting quite conservative, getting quite defensive, and just not keeping as much inventory, really right-sizing their cost bases and retrenching. So you've seen the impact of that on places like cyclical chemical companies. Very significant volume reductions on their top line, because their customers are just becoming quite cautious. So you're seeing pockets where there is, clearly recessions within industries, and that's what we're paying very close attention to.
But this may be just a question of timing, because if you think about historic periods of time where rates suddenly rose, you really didn't see a recession or recessionary pressures until 12 or 18 months thereafter, until after the peak rate was hit.
Right.
And we are not 12 or 18 months since the peak rate has been hit, in global markets. And so we are, in the short-term indicators, especially those that are backward-looking, how did a company perform last quarter or the quarter before or the quarter before? It's not necessarily indicative of how it will perform in 3 quarters, or 2 quarters.
And what's interesting is that in the UK, certainly the biggest impact on the consumer by far is going to be when all these medium-term 5-year fixed mortgages roll off, and suddenly the consumer has to refinance onto a floating rate that's significantly higher. I mean, forget inflation and food prices. This is going to be the single biggest impact on discretionary spend, and it's still coming. It's as you talked about, Armen, this is coming in 3, 6, 9 months, not today.
So we're thinking about opportunities, risks. In Europe, obviously, jurisdiction plays a big role. So I'm curious now, give this to you. What do you think the differences are between jurisdictions in terms of opportunities, maybe risks?
Very significant, and the reality is there isn't a single answer because it's constantly changing, and there's so many facets to it. I'll name a few. The first, obviously, is political. So take Brexit. How do you underwrite UK as it goes through Brexit? It's virtually impossible to underwrite the exit at that point. Some of it is as simple as macroeconomic. Germany was the powerhouse. Now it's going through a really, really tough period, and so any private credit investor looking to underwrite Germany at this point is going to ask for a bit of a premium to take on German risk. And then some of it is just simply structural, historical issues in kind of law or jurisdictions that have never changed. So take Italy, there's just a lack of banks that operate in the middle market, and that creates a vacuum for private credit and alternative lenders to come and fill the gap. So there isn't a single answer, unfortunately. It's one we monitor the whole time because we're trying to balance at any single moment where the best risk reward lies in Europe and try and pick and choose.
It's one of the wonderful things about European investing is there's always something going on. If not today, it will invariably come quite soon because it's not a uniform landscape. The political environment is so different and the cadence of political events is so different. And with Europe, you can wait and be patient because there will be an event which will blow out the spreads and make it look, compelling again. So it's just, as you were saying, it's lots of different things which make it always worth looking at for an opportunity because there will invariably be one of mispriced risk.
So, we've talked about a lot of specific risks, but I'm curious to get your sense of near-term, medium-term default risk, both on the private and liquid side. Madelaine, I'll start with you.
Well, the market has got to a place of pretty much full recovery in terms of providing capital with confidence to good quality companies. So good quality companies who need to refinance their balance sheets that have a maturity impending this year, they have found a way to do that. Even good quality companies facing maturities next year, most of those are already done. So really the trigger for default, if it comes from a maturity driven event of default, is very limited. This year and next year, there really isn't much that matures. So it would have to be a company running out of cash. And given that we've seen a recovery and pretty healthy performance from companies, there aren't that many that fall in that category either. And what we found is the ones that do in the market are the ones that were already impaired prior to COVID, frankly. They've been long-running operationally challenged businesses for a variety of reasons. So you will see that cohort now not finding an easy way out because no one's bailing that kind of risk out anymore. But really substantial defaults, we don't see that. And one of the things I think we have had the luxury of is that unlike other periods of downturn, we've come into a downturn having had a couple of nasty years. You've had COVID, you've had in Europe, Ukraine. And that has meant companies weren't gangbusters, expansion, M&A, et cetera, et cetera. It wasn't happening so much. They were a little bit more conservative, pushing out maturities, getting cash on balance sheet, not paying loads of dividends out, not doing the massive capex plan that they may have done in a different climate. But with that sort of fiscal conservatism behind them, gives them a bit more, at least bandwidth and time to come out with solutions if they have a debt load which looks very toppy in the new interest rate environment.
So this quality comparison, I think, is a critical point between Europe and the US. I think in Europe, because of all the factors Madelaine pointed out, the average quality of the senior loan or high yield bond market is just higher. The companies are less levered, they're more stable, they haven't overspent, there wasn't a hyperactive private equity community. However, in the US, the split of the market that is the lowest quality but just above triple C currently in the senior loan market is the highest it has been in about 13 years. And that is because the US, unlike Europe, loved credit, loved leverage, loved hyper levered buyouts with very creative add backs to EBITDA when they did lever up these companies. And none of those, creative, highly adjusted EBITDAs have really worked out in the end. And so the likelihood of defaults because of cash flow drying up in the US is far higher than that of Europe. I think what probably is more on par with one another would be actually the US high yield bond market in comparison to the European high yield bond market or European senior loan market, in that the latter three are actually less levered today and higher quality today than they have been for most of the last 12 or 13 years. Whereas I think uniquely to the US senior loan market, as well as to some older vintage direct lending, the leverage profile of those companies was very, very aggressive. And when you combine that with an elevated cost of borrowing, their cash flow is drying up much, much faster. And the default experience is going to be more elevated in US senior loans in particular, relative to European high yield bonds or senior loans or US high yield.
Look, I think what Armen said about Europe having generally higher quality issuers in that respect and fewer restructurings is spot on. If you look back at the period post GFC, you'll notice there was only 12, maybe 15 overall true distress for control deals in Europe. And that actually gave the banks confidence in a certain way, which is to say that doing nothing ended up being a phenomenal result.
Great strategy.
A great strategy. And so today you see a lot more of the same, which is amend and extend and really no proactive decision making unless there's a liquidity need. But today that's the exception rather than the rule.
So kind of as we end, one of the things I'm curious about is, from your discussions with companies, the work that you do, are there any trends or risks that aren't being widely discussed that you think people should be more focused on?
I'll jump in and start on the private credit side. Look, if you asked me this question 18 months ago, I'd say ESG and then ESG and then ESG again. But I think now that's pretty much at the forefront of most corporates thinking. The one that isn't, but we see on every single deal, especially post the start of the war in Ukraine, is sanctions. And sanctions is an interesting one because it never used to be part of a DD process 10 years ago. Now it's in every single DD process, and it cuts not just revenue, but of course the entire supply chain. And then you've got the whole sectoral and subsector diligence that you have to do as well. So to me, it's one that hasn't come to the fore in terms of people talking about, but it's at the center of every single DD process very early on as well, in terms of go no go decision.
I think the list of my worries is really long and constantly growing. I think the one that troubles me, and I'm not sure how it resolves, is this consistent labor shortage we have. And something happened in COVID where we just removed a part of the labor force permanently, seemingly not coming back, and how companies deal with that. And again, going back to the risks of interest rates being higher for longer, I think that penny maybe hasn't dropped everywhere in companies, that really this might not be, you really are stuck with that balance sheet and you don't have a free pass this time.
And to Madeleine's point, some portion of the labor force globally has just exited. Unclear as to how they're able to do that, but that I think is an interesting point, and whether that reverts or not. Usually what you need is a recession for people to appreciate their jobs again, and that's something that could end up maybe changing that dynamic. But one, I think, big picture risk and opportunity that I think will become at the forefront of investor minds, CEO minds, is artificial intelligence and machine learning. I think it's just presumed that it'll just kind of all be okay. But there will be winners and losers as a result of those that are at the forefront of using AI in their business processes. And there will be the opportunity for countries, for businesses to leapfrog others, because I don't think that anybody really has a monopoly on AI and the capabilities therein. So it's something that, I wouldn't say it keeps me up at night, but I wouldn't be surprised if one day there's an upstart business that has somehow solved AI. We think about ChatGPT as, oh my God, this is so smart. But at the end of the day, it's just really smart machine learning. It is not artificial intelligence, but that is, and to me, ChatGPT is a really quick, cool computer program, but But at some point, there's going to be a real development in AI that changes an industry fundamentally and changes the power balance within an industry or even in a region with respect to certain countries and the capabilities that they may develop as a result of it. So that kind of worries me. But I do think it's important for companies and the C-suite of those businesses to think about how AI is both a risk and an opportunity in their business process.
Well, you won't be surprised to know that the analyst teams are busy, theorizing about this. It's early, so a lot of it is theory, but at least asking the question, what could happen? What could happen to my business if, this is adopted or this becomes useful for competition? What do they need to do? Can they benefit? Can they lose from it? It's being weighed up, and we'll see how that falls out.
It's interesting from everything you've said. It's like, we came from this prior period, the last 10, 15 years where it seemed like, interest rates were very low, geopolitical risk was fairly low, technology was changing, but you weren't maybe making these huge leaps. And it just seems like now there's so much uncertainty in so many different ways. Kind of speaks a little bit to, what our co-chairman Howard Marks wrote about in his Sea Change memo from late 2022, this idea that we're just perhaps entering this new era.
And it just makes it hard to predict the outcome when you have so many large factors moving in independent directions. They're just not correlated with one another. Technology, rates, geopolitical concerns, war. There's just so much that could change your assumptions so quickly and so materially that it becomes very hard to consistently invest and just kind of close your eyes for a long period of time in the current market environment. It makes for active investors like Oaktree to have a pretty nice set of decisions to make over the next few years, but it's not for the faint of heart, I think.
But it also speaks to the fact you should never be too complacent, right?
Right.
Yeah.
We look back on that period, and at the time, I'm sure we didn't feel like we were in the good times.
Of course, right?
But
right.
in retrospect, they were a lot better than they are today. But again, there are opportunities within the fallout of all of that.
So I guess as we look at, the state of European credit, the state of credit overall, any final thoughts that you have to end with?
Well, I think it's got to be a period of reflection on big events that have happened, a shaking of the kaleidoscope, and then a reassessment of risk. For us, it's a time where we're looking for those opportunities, potential return that we can get for risk which we think is high quality, companies where we believe that they will recover well, pay us our coupon, pay us our money back at maturity, and that potential return can be an outsized value for the risk presented.
I agree completely with what Madelaine was saying. I mean, if we look at our pipeline today, it's most attractive. It's been for the last 12 to 18 months. And you can just simply, without having to go into each different credit, look at the LTVs and yields and just their position in the market, and just look at those three metrics, and you'll see that it's been a sea change over the last 18 months versus the competition that we historically have seen in Europe, at least, with the amounts of funds coming in. Now, there were about 900 funds in Europe this time last year. It'll be interesting to see how the market shakes out. But one thing is for certain, I think more and more funds are recognizing this need for real downside protection due diligence, real operational capability. And so there's more and more demand internally to grow their resources to bring in these type of capabilities that are also few and far between in Europe, by the way.
And I think the only thing I would add is that, kind of coming full circle, there's a lot to point to in the near term, or that has just occurred in the near term, that would indicate that things are going to be just fine. But to Madeleine's point about complacency, I think savvy investors should think about the medium term and the long term, and think about whether there are fundamental shifts that have happened, sea changes in your fundamental set of assumptions that call into question whether these short-term backward-looking indicators should be blindly followed and accepted. I think there are a lot of risks on the horizon. So as a firm, we look forward to that opportunity set. And I think whether it's in the performing credit areas or the non-performing credit areas and real assets areas that we deploy capital into, I think we're excited about the potential return opportunity and the ability for us to manage that risk profile well.
Well, I think that's a great note to end on. And I'd like to thank you all so much for joining me today.
Thank you.
Thank you.
Thank you.